Hello, everyone. My name is William Mucker. I am a client executive with Camaplan and would like to thank you all for joining us for today's webinar, 10 Strategies for Acquiring Assets at an Average 22% Discount in the Short-Term Rental Market with Richard Wilson of Investor Residences. As a quick note, please be aware that Richard will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I'll be more than happy to help. And without further ado, I'll pass it over to you, Richard.
Awesome. Thank you for having me here, Will. Appreciate it. And I've enjoyed getting to know Camaplan and many of the executives and your staff. I've gotten to come to your headquarters one time. And I believe we have a couple of investors already in the investorresidences.com platform into our short-term rentals through your platform. So appreciate the support. I'm going to share my screen here now, get my PowerPoint up. So I'm sure I could take an hour going through these PowerPoint slides, but I'm sure everyone values their time here. So I'll go through these pretty quickly, but we'll have time for questions at the end. So if I blow through something too quickly, feel free just to enter the question in the Q&A panel here and for the webinar, and we'll get to that as I get through all the slides. Essentially, what we're doing is building out a 100+ property vacation fund in the short-term rental space. Many people have experienced staying at Airbnb properties. Those are all short-term rental properties. It's a form of hospitality, basically leveraging residential houses. And so what we do is typically buy a house below its listing price by offering all cash or doing all cash with some seller financing. And then we increase the sleeping capacity and improve the property. We'll show you many examples of how we're doing this right now in our fund. Right now, we currently have over 85 different units in our fund, some through our own management and some through a couple of co-investments that we've done. So we're going to show you pictures of those assets and some strategies and examples that we use while managing assets in this asset class. So some of you may use some of these strategies for a short-term rental you own currently. That's great. You might use this for an asset you're debating on buying at a lake or a beach location that your family visits all the time, or just be opening your eyes to this niche. A lot of investors know about multifamily. They know about storage. Not many know about the short-term rental space. So here's a couple things about what we're looking to do. Basic formula is that our investor club that's behind this platform has been around for 16 years, and we've hosted 190 live events. It's called the Family Office Club, and we have over 25 employees on the team. So we leverage that, plus our abilities of managing the short-term rentals. We're a super host with Airbnb and gather properties below their listing prices, improve them, and then that's how we work towards doubling your money. The doubling of your money part is really important, very important to us, even more so than to you, because the only way that we make money is after we double your money. So this is not like a normal fund where you get charged an acquisition fee and an annual asset management fee and a capital raisers fee and a whole bunch of other fees every year or upfront. We're actually, besides paying our taxes, cleaning, repairs, renovations, our property managers, we're not taking asset management fees upfront or annually. We're having all the profits streamed to the investors until they double their money. After you double your money, you're left with vacation credits in the properties, and you've already gotten a 2x return on your money. So we're structured in a very unique way. We structured this with a law firm that's put together over 600 investment funds, and they've never heard of anyone waiving the fees and doubling your money before they make any money. But in our mind, it's the ultimate alignment model to have in place. So here's a quick picture of our team. We have 6 or 7 professionals from the hospitality industry, mostly Marriott. We like hiring people from there. And we have a pretty diverse team from multiple countries, multiple languages being spoken. A lot of our employees are in the states of Arizona and Florida, though, but we do have some staff spread out across a few different countries. There's a picture of the founder of Keller Williams Realty. They have just under 200,000 real estate agents. And Joe Williams just spoke at our event last week. We're going to do a fireside chat with him at our next event. And I encourage you to check out our events. If you're an investor, you're not raising capital for anything, our events are free for you to come and check out. And you could meet with Carl from Camaplan. You could network with other peer investors. And our events have 70 to 130 speakers on stage at each one. Joe Williams is an advisory board member to our short-term rental platform. He's also an investor. So that's why we have his picture up here. We have great ratings on our current properties. And that's super critical in our space. Whether the customer is right or not, you want to exit the situation with a good 5-star rating. Every once in a while, you'll get a customer that really does damage to the place and doesn't really respect the place or breaks a couch and breaks a couple other things, et cetera. But there's Airbnb insurance for that. But in general, our goal is always to leave them with a great feeling. So they're always leaving us a 5-star review. And we have many strategies around how we do that. As I mentioned, we're a super host. We leverage a property management communications platform called Buy More Time. So that's going to come up later in the presentation as well. This is one reason why we like short-term rentals. This slide, 25% of all apartment buildings are owned by institutional investors like pension funds, endowments, et cetera. But only 2.4% of single-family residential assets are owned by institutions, and less than 1% by our math of short-term rental properties are owned by institutions. We think that's going to change over time. It took a decade for multifamily to go from 10% to 25%. It's taken many, many years for single-family residential, SFR, to go from 1% to 2.4%. So it takes time for these changes to happen. But as that money comes in more and more and more to the space, the value of those assets go up and the cap rates they sell at go down. That's what we're counting on in part in investing in these assets. So here's one asset we bought, a great example of what we do. We found this asset and it had gone through a broken sale, meaning someone tried to buy it and then they didn't get the financing, ended up walking away or not closing for one reason or another. So the seller was in France and she just said, I just want to sell this thing. So even though it was worth at that time, we believe 1.33 million, she had it listed for 1.25 million. We are adamant about not paying more than 1 million. We failed to do that. We actually paid $1,050,000. So just over 1 million. And the property, we gained a big gain on that property right at the closing, right? Because it was worth 1.3 million, according to all the comparison websites out there and valuation websites. Today, it's worth 1.55 million. It's in the Park City area. We closed all cash. We did a 17-day closing, and we got a big discount on the asset. If you believe that over time, with inflation and increase of wealth in general, that real estate markets always go to all-time highs eventually, even if there's up and downs, then buying assets at 20 and 30% below what they're worth really lock in some gains for later. And then it's about getting some decent cash flow and improving the asset, of course. So we're protected a little bit because this was purchased using this strategy of all cash at the very top of the market. This was October, not of 2022, of 2021. And so it was really the hottest market the United States had ever seen. And we were still able to get a massive discount by offering all cash. Here's a couple of stats on it real quick. 31.1% below the average price per square foot of homes sold in the Park City, Summit Park area. So it's about 15, 17 minutes from downtown Salt Lake City. Here's the inside of the unit. All right, transaction number 2 was just unheard of deal terms. We did a co-investment into a portfolio of 70 short-term rental properties. And if you're a larger investor listening to this webinar, you'll have the ability to do this as well. You can go to someone who runs a fund and say, well, we'll be one of your biggest investors, but we want special terms. So instead of the normal terms, we want to get a higher preferred return or whatever you want to negotiate, right? So in this case, the group usually gave an 8% preferred return. We negotiated a 16.5% preferred return and a 50-50 profit split after that, which are really unheard of terms. I've never heard of anyone getting that exact set of terms. I've heard of a 16% preferred return, but then you get 0% after that. Most people don't want to give 50-50 profit split after that high of a preferred. So we're excited that that's part of the fund. It's part of one of the investments that we closed on. And we could do a follow-on investment with them, which we very well may do this year. Right now, we're focused on acquiring assets in Hawaii, in Florida. And if there's a chance to buy a motel or something that can convert a motel hotel into a short-term rental property, that could be something to make an exception for. But otherwise, we're really trying to aggregate assets in Hawaii and Florida. But we always have the option to invest in this group's next fund, hopefully at these exact same terms. This is transaction number 3 I wanted to share with you. This asset was listed for $1.3 million. It's called the Jurassic Retreat. Probably reminds you of a movie that you've probably seen. And we bought it for $1,050,000 again. This one was not all cash. We did 25% seller financing, almost all cash down. And what's great about seller financing that we love is that the document that backs the note, sometimes they'll ask for the house to be collateral behind the note. Sometimes I don't, and it's just a note that technically doesn't have any collateral behind it, which is interesting. But also, the document is 3 pages long, and you're getting the same rate that you would get if you went to the bank, that you would get through seller financing, or lower. This one, I believe, is at 5.5%, if I'm not mistaken. And so when you have a 3-page legal document around a debt note, then that's much, much better for you as a borrower than an 82-page document from a bank that may say you broke this covenant, or we're calling your loan, or technically you broke this debt to equity ratio, or on page 72, we have the right to call this loan at any time, et cetera, et cetera. There's lots of bad things that could happen when there's an 82-page legal document versus a 3-page one. And it's just much more complex, much more simple to go direct to the seller, not deal with all the bank hassles. And an interesting statistic is that right now, 27% of all real estate deals put under contract do not close because banks mess up the deal. They don't provide the financing. They ask for 19 things the day before closing, as I'm sure you've experienced. And so because of that, we have an advantage when we go to sellers. We say, well, we could offer all cash at this amount, or all cash with seller financing at this other amount if you give us this rate of seller financing. For some people, they care a lot about the rate. For other people, they care a lot that it's all cash. For other people, they care the most about the ultimate sales price or the tax impact of it. And so we stick to our guns on it, though. If we're not getting it at a great price or a good price for the value of the asset, then we just move on. We had a 10-unit boutique motel in Florida that we really wanted to purchase. It was amazing looking. We thought it was worth 2.1, maybe 2.3, 2.5 on its best day. And the sellers would not budge. They started at 3.3. They really wanted 2.8 or higher. And we said, well, we're just not going to overpay. So we'll come back to you in 3 or 4 months or 5 months. And when nobody else has purchased this, because a 3% cap rate is crazy, we'll buy it from you then. And so we emailed them last week and they said, oh yeah, somebody else put it under contract, but they didn't close because their financing fell through. So now we're back on the market. And they're trying to sell it at the same price still, but they took the risk of the bank. If they had given us seller financing, which we are negotiating 3% interest rate seller financing, and took our price, they would have had a sale made and could have moved on from that asset. But when we don't connect on the right price, then we don't move forward. We're not here to buy beautiful looking assets at top of the market prices in a wobbly market, obviously, right? So that's really important to us. There's a couple pictures of the Jurassic Retreat. These are animated dinosaurs that make sounds and move when you push that little green button on the fence, for example. Here's inside. It's a pretty new construction, and you got a big T-Rex head there. The whole thing is outfitted to feel like you're in, a Jurassic Park movie, essentially, right? Next transaction is number 4 in Sedona. This one is cash flowing for us the best out of all of our individual assets right now. It's actually 3 assets that we bought on 1 acre. It appraised at about $1.3 million. We bought it for $925,000. And we did a fast renovation in 2.5 months. The expected return is 2x over 4.5 years on this asset. It's a little bit higher than some of our other assets. And in general, a strategy to take away, whether you would want to potentially invest with investorresidences.com or not, is just that when you buy an asset that has a couple of units on it, you oftentimes get a lower price per unit for that asset, but also you get efficiency, right? So why do institutions invest in apartment buildings and own 25% of all of them? Because with one transaction and one closing, they can acquire 700 units or 300 units. If you want to buy 30 short-term rental properties and all 30 are in 30 different markets with 30 different cleaners and 30 different property managers, you will lose your mind and it'll be overwhelming, complex, messy. If you instead bought a 5-unit boutique motel, and then you got a 4-plex over there, and then a 10-unit boutique motel, and then all in one beach community picked up another 7 assets. And I realize it probably doesn't equal 30, but if you did it that way, you're going to have much more efficiency than 30 different homes and 30 different markets. So efficiency is important for operating, but also just your ROI on investment goes up when you can acquire multiple assets on one property or one piece of acreage. So that's important to us and something that we look for. The property, you can see the main street of Sedona here on the left. There's a famous Italian pizza place that's right on that street. And when my wife and I walked through the house for the second time here, last time we went out to eat and it was literally a 2-minute drive. You could walk to that main street. So it's a great location, pretty big piece of land for Sedona. A lot of the properties are half or a fourth of the size land-wise. So we're really happy with this asset being in the portfolio. This is what it looked like before we did the renovation. So it looks like you need a tetanus shot if you want to make dinner inside that kitchen. Very old, not attractive, and very just outdated. This is what it looks like afterwards. So we put a sauna in there. We have everything. We have beams in the ceiling, nice lighting, new everything inside, and it really helps boost the rental rate we can get per night, the average daily rate, but also the sleeping capacity is 30. Out of 2,700 assets in Sedona, we sleep more people than anybody else on Airbnb. And we have achieved the same thing in the Grand Canyon Junction area with our asset there that we're going to show you in a couple of minutes. With this next transaction, we kind of were able to go back in time. This is a very small investment, our smallest investment in the fund, but it's a strategy you can use too. So we found a fund that had gotten to the end of its capital raise, but was still technically not closed. They technically had a little bit of space open. So they allowed us to invest, and we invested on the same valuation, the same terms as investors did who put in their money a year and a half ago. And a lot of those assets had appreciated, and we were able to invest while having 100% transparency of what's in the fund and already being in the money by a good amount because those houses had appreciated a whole lot in 2021. So we made this investment and back in 2022. And I think it's going to be a great investment for us. It's a smaller one. We're testing out this third-party manager and just kind of getting to know them and how much we could be working with them going forward. This is our next transaction I wanted to talk to you about. This one would probably be worth 2.6, 2.7, the top of the market. It was listed for 2.2 million. We acquired it for 1.7 million, putting about $75,000 into renovation work into it. We're boosting the sleeping capacity by about 50%, replacing all the patio furniture, which was about 30 years old. You can see the lovely paint color of beige, not very exciting or cheery. The grass was just a big patch of grass with a hole in the middle of it, where we've since patched the hole. You won't see that in the picture I'm about to show you because we just patched it, but you'll see the other things that we did. There's lots of rusty things, washing machines, dryers. We're replacing a water heater today. Just really mom and pop management on the pricing, done with no pad and pen. And they did a pretty good job for being so old school, but everything was outdated. Everything was junky and felt bad, super yellow mattresses from the 1970s and stuff like that, right? So this is how close it is to the beach. So it's oceanfront, I guess. There's jungle in between us and the ocean, but in a little, you walk through that jungle, it takes about 3 minutes and you're right there at the beach. And it's really quite a private beach. There's almost no one ever on that beach, but it's a great surfing beach, lots of bodyboarding and surfing going on. So it's a great location. This is what the house looks like now, paint color wise. You can see we added a volleyball court. There's actually 2 sets of hammocks. We have one here three of those four kids there in the hammock are mine when we were there over Easter. And the kids loved playing the volleyball and playing on the hammocks. And we added some amenities, surfboards, beach chairs, beach toys, etc. That's why people go there. And we've made it pet friendly as well. So you can see what we do on the asset before we own it versus after we own it to help boost the experience for people there. This asset is another one we have in our portfolio. It was one of the first ones we acquired. We sourced this off market, meaning it was not being shopped around. We looked for the largest assets in the Grand Canyon area, found this one, and were able to negotiate it offline. Importantly, this is a themed asset that was a trading outpost for 30 years. And so in its bones, it's a trading outpost. It wasn't like we put up a couple posters to try to make it feel like the Old West. All this stuff, the carvings, the statues, the gateway, et cetera, was there. And it's very unique in terms of the size of the property. Also, remember what I said earlier about buying multiple properties with one transaction. We bought 2 properties on this one transaction. So it's a 2-acre asset. And there's 2 houses, the front house that looks like the outpost and a back house, which used to be the owner's quarters for the outpost. So there's 3 million tourists a year that go to the Grand Canyon. When we bought this, it had $50,000 in bookings that were already booked on it and coming in. There was a $1.5 million asking price with the starting of the negotiations. We bought it for $1 million plus furnishings. And again, we got seller financing, 25% at 5.5%. So we believe this one's going to be a good value over time. As the Airbnb market becomes more competitive, it'll continue to be a nicely themed property that's unique with large sleeping capacity. We're fixing some pipes that were not buried deep enough, so they freeze in the wintertime. So we're getting that fixed. We made a trike track in the back of it so kids can ride their trikes around there. We have some 3-wheelers back there with some helmets. We also have a playground we built in the backyard. We have fire pits and 2 different decks. And then inside is really decked out with decorations and foosball and full kitchen, of course. And everything's decorated and done in a very tasteful, nice way, as you can see here in the pictures. This picture is from one of the 7 assets that we invested in. This is from a house in Orlando, which is near Disney World. So it's kind of a castle themed one. It's just an example of another theme. Just like this is kind of an Old West theme. This one here is obviously themed like a castle. Another transaction that we're working on closing right now is a equity transaction into Buy More Time, which is a communications platform for short-term rental properties. And we know the owner of this business very well. We've been able to help them scale the business, and we are acquiring a 33% equity stake in this company, which should be going into the fund here shortly as well. So if that company expands, if it sells one day, that is going to help us with boosting the returns to investors. And best of all, we were offered a 33% equity stake in this company without even having to invest money into it because of our investor club and how much we've helped them to date, which is a really unique situation. But then when you think about what I told you on our structure, we don't make money until you double your money. And so it does me good to add this to the fund and add this to your potential returns if you're an investor, because then I benefit by doubling your money that much faster if I put good equity stakes and good investments into the fund, right? It's a pretty unique situation. This came about because of our investor club, not because of the fund. So technically, I could have just said, okay, thanks for the 33% equity stake. Awesome to have that, but instead we're putting it in the fund because it's just the aligned thing to do. And that shows the power of having an aligned investment structure versus someone that makes money off of you, off of fees up front and every year. Yeah, it really separates us from every other real estate fund out there that I've ever heard of. And we've hosted 195 investor club events. And many of our events have 700 people at them, 300 people at them, et cetera. So we've talked to a lot of people in the space. Here's some terms around our investment platform, in case you have any questions about it. Essentially, what we're providing people is exclusive experiences. You can stay at the properties while you're an investor. If you don't stay at the properties, you're not penalized by that. You're not missing out. Essentially, if you don't stay at the properties, you double your money cash on cash. If you stay at the properties sometimes, then part of the value of that night goes towards the doubling of your money. So maybe if you enjoy the properties a whole bunch, you just get a 1.86 or a 1.85 return on your money. and the rest of your return came from staying at the properties. Or if you don't stay there at all, just be 2x return, cash on cash. Many predict that there's going to be heavy inflation due to devaluing of the dollar globally over the macro time, but also there's just been inherent inflation that the government's trying to control through these higher interest rates. The more that the economy becomes unstable, the more that we're going to get further and further discounts by making these cash offers. We're only about 35%, 40% of the way through acquiring assets for the fund. So we believe the pricing will only get slightly better. But if inflation takes off, you don't get left behind, because real estate and nightly rates typically track inflation. Do people travel less if there's a severe economic depression? For sure, they'll be impacted some. But over time, it should just mean acquiring better assets at better rates, and then be working through that. And so that when the economy comes back, we're in great shape, and we bought assets that were below the list price. And what's most important about that is that was below the list price, but that list price was already adjusted, right? The list prices today, and even 6 months ago, were below what the list prices were 2 years ago. And so at some point, it's going to go back up to a record high again. And we'll have bought not only below today's list price, but below, far below what top of the market list price was. So even if there's no inflation, or very, very little inflation, because there always is some, and we just get back up to that market high, we should do well. If there is heavy inflation, then, and if interest rates come down, then we'll be in a really great spot on the properties. So our job is to manage them well quarter to quarter, operate them well to produce some quarterly profit shares for the investors, and just make sure we buy them at really smart prices. As our network of properties grow, you have more properties you can stay at. And after you double your money, you get a vacation credit you can use to stay at any of our properties. And that's every year you get a vacation credit to use for as long as we own these properties going forward. So if you want to put your capital to work, we've given you a lot of different strategies. You can use these on your own. You could use these for a property you may purchase in the future, or this may just open your eyes to the short-term rental space and some of the strategies within it. If you would like to put your capital to work with us, what we're doing is looking for off-market assets, reduced price acquisitions. We're looking for old boutique motels or boutique hotels we could turn around or acquire in places like Florida and Hawaii. And while we have assets in many states right now, we're really focused on Florida and Hawaii most going forward for a variety of reasons, like demand, year-round, stable demand, et cetera. We purchase real estate sometimes, and it might just be a house. It's not an Airbnb asset. It's not a business asset that's producing a profit. It was just somebody's house, and then convert it into an Airbnb asset that produces profits. And then it can be valued as a business, even though it was purchased as a single family home. That's important because it's an arbitrage that we can make. You get quarterly cash flows. And then our goal is between refinancing the portfolio, selling off part of the portfolio, and the cash flow along the way, that we double your money over time. You can stay at the property. We have a general rule of, basically one night at the property for every $25,000 you invest. If you do invest through your self-directed IRA, you cannot enjoy this for personal use. That's only for if you invested outside of Camel Plan, unfortunately, because self-directed IRAs have strict rules about it. Last thing you want to do is lose your ability to do this in a tax-protected way by personally enjoying the asset. But as I mentioned during the presentation, you'll still 2x your capital over time in the asset, even if you do not stay there. And we see this investment strategy as pretty low risk and moderate to high return with potential, great memories along the way. And we see it as relatively low risk because, remember, we don't have any bank debt on any of our assets. We have low debt when we do have debt. Our average debt is 20% on our properties because that's seller financing. And usually they just want to go at 25% or 33% seller financing. And sometimes we buy the properties all cash, like the Florida fourplex. So it's pretty low risk. And we're buying them below the list prices. And so that reduces the risk as well. If the market drops 50% from where it was at the high, it's like, okay, well, we bought our average property at 22.5% below list price, and that list price was a good 10% below the top of the market. So maybe worst case, a couple of our assets go down 17%, and then we pick up some more assets at those low prices, and it might be a great thing for the fund. So we're very confident about that part. I think long-term, between inflation and market appreciation, it's going to be a great portfolio to be part of. If you do want to learn more, it's all properly structured with PPMs through a fund and a fund attorney that's put together 600 funds. And one thing we like to always end with the webinar like this is a book that I read from Howard Marks. Some of you may know that we bought the domain name and the website billionaires.com about a year and a half ago. And we've been interviewing billionaires and have some of them speak on stage at our events. And this billionaire is the founder of Oak Tree Capital. And in his book, everybody's heard you should buy when there's blood on the streets, just no one really likes to do it because it takes a lot of courage and timing. And what Howard Marks says, though, is he says it in a much different way that's more helpful. He says, when you see risk in the market, just know that because everybody sees that risk, there's actually less risk because the market now is on sale. When you can buy assets at 22% off or 30% off what they were at the top of the market, don't think, oh, that's risky. It's a risky time to invest. Think, well, there's less risk because now I'm buying at a discount. He says the best deals he's done is when everyone thinks that the world is toxic and you shouldn't be investing in anything. And that's when he gets amazing deals done. So this is coming from a billionaire. And this billionaire is humble enough to say that he is not so smart that he can predict the future, even though he's worth billions of dollars running a hedge fund. But even though he can't predict the future, he said, you better be able to stick your head out the window and see where you are in the pendulum and which way things are swinging. And so I like a couple of those quotes. If you want to check out his book, The Most Important Thing, it's great. But the main point here is that while a lot of investors are sitting on their hands right now and they're not sure about this, they're not sure about that, they don't want to invest because they're not sure about this other thing yet. It's like, well, by the time you're sure of all that stuff, then the market will have gone back up and appreciated. So I just like to layer into things because then you cannot be completely off by just going in at different intervals of time, every 2 months, every 3 months, every 4 months. And then that way you're never completely wrong. You're never completely perfect on the timing. And it's a blended approach to making sure you're getting good value for your money. Wall Street Journal posted this. They said the luxury home market posts its biggest decline in a decade. It's like crickets. They posted this September 2022. This is great news. This means we're buying properties that right after and during the biggest decline in a decade. That's what you want to do. You should be afraid. You should see risk when it was at the top of the market 2 years ago, when everyone was pushing money on everything around them as fast as they could. That's when we are paying top of the market prices. Right now, there is less risk because we're not paying top of market prices. So again, we have our 25-person team. We're a super host. We buy these properties, increase our sleeping capacity, acquire them below list prices. And our goal is to double your money. And we don't make money unless we double your money. So we're pretty motivated to do that compared to other groups out there would like to believe. And if you'd like to reach out, you can shoot me a text message, 305-333-1155. My name again was Richard C. Wilson. My email is richard@investorresidences.com. And if anybody has questions, I'd be happy to take those.
Great. Thank you, Richard, for the great information. And as Richard said, please use this time to use the chat and the Q&A function of Zoom to post your questions for Richard. To get started, I know a lot of people have been worried about the things going on in the economy now with the different banks and all of that. From what you said, does that mean you and Investor Residences have been more aggressive in purchasing properties at the moment, or how has that changed up your approach to your investments?
Sure. Yeah, we've been pretty steady. It seems about every 5 to 6 weeks we are acquiring another property, but right now I'm not sure if we'll hit that 5 to 6 week rhythm because right now some stuff hasn't been underwriting as well as we'd like it to. But we don't deal with the banks at all. We don't have debt with the banks. We don't carry large cash balances with banks that would put us at risk of like a Silicon Valley Bank type bank failure or anything like that. Our capital is put into the properties on a rolling basis. And your experience as an investor is when you enter the fund, then you start getting quarterly cash flows and profit shares, and you're in it until you double your money in the fund. And so our exposure to bank risk is relatively low. Of course, if more banks become contaminated and many more fail, and it starts freaking people out even more, then of course that it could impact the economy, and then prices could come down, which would be a pretty ideal scenario for us, because we're not looking to exit these properties. We're still fixing them up, turning them around, building up reviews, and going through these 9-month phases of getting the properties fully functional and upgraded to be really cash flowing well. And so, and we're only about 35% through allocating the fund into properties at this point. And so if the market continues to slide down, which most financial experts believe it will through the rest of this year, it'll only be good for us. And if it takes a sharp decline down, that would also be good for us. We're just being really cognizant on the level of debt, because the only way a depression or great recession would be harmful is that, quarterly profit shares could be more slim if the economy hits short-term rental travel. But having very low debt levels allows us to still skate through that, compared to competitors who might have 50 or 60% debt versus our 20% debt.
Okay, wow, that makes a lot of sense. Thank you. Another reminder, please use the Q&A and chat function while we still have Richard and his time. Another question is, obviously you guys have experience working with IRA investors and personal investors alike. What's your approach for IRA investors and for people who might want to use different entities like IRAs with their personal funds or so forth?
Sure. Yeah. I mean, it's pretty simple. The only restriction is really the personal use element. And then with CamaPlan, I believe that my investment admin just coordinates with CamaPlan. And then we have the list of distributions that go out to the multiple investors with CamaPlan, and then that gets pushed through the CamaPlan system. So it's really quite simple. We have a DocuSign process for the legal docs. We don't need wet signatures and things faxed or mailed or notarized or anything like that. Like any formalized investment fund, there's more pages of documents and disclosures to read than you're probably going to want to, because it's all done the proper way. And these days, the proper way means 180 pages of things that you're supposed to read through. But we're here to answer questions and to make sure that the structure is clear to everybody as they go through that paperwork.
Absolutely. That makes it a lot easier for investors, especially when they're working with their IRAs. Any questions? Of course, this is being recorded and will be sent out to all registrants and posted on social media. Any questions that you think that people watching this after the fact might benefit from the answers to?
Yes, a lot of people ask, how does it work in terms of, if I come in earlier versus later in the fund? And so the important thing to remember is it's not a normal fund where, like I talked about, that 7-property fund, where if you come in late, you're at an advantage because now you can see the properties, but also those properties have appreciated. In this case, you're getting the quarterly cash flows, and then you're in it until you double your money. So there's really no big disadvantage or advantage coming in really early or really late, et cetera, like there sometimes is with a fund. The other thing is people ask, what is the IRR expected with the fund? We're aiming to produce anywhere between a 12 and a 15% IRR. If we can get 17 or 20%, I'm sure that will just make it that much easier to raise capital in the future. But we want to make sure that we promise something that we're under promising and over delivering, and where interest rates go will drive that IRR. We think, based on moderate assumptions, that our team's performance can get investors that 12, 14, 15% IRR. And if interest rates go back down to record lows at some point again, then that's going to help hit those higher numbers and beyond. But some of that stuff is out of our control. What we can control is just buying the properties at great prices and then operating them the best we can to produce good cash flow for the investors. And then lots of times we get questions about what assets, like what markets our assets are in. So if anybody has questions about that or wants to watch or share, just like someone maybe on your team or your spouse may not have been able to join this webinar, and I know they're going to send a recording out. But one thing that could be helpful is that on our website, we have a area at the top called portfolio. And if you look on that page, you can see our current properties and you can actually view the Airbnb listings. So you can see that one, yes, these things do actually exist. And two, we do have great ratings on them. And you could even go stay at one of them as part of your fun due diligence on us or something if you wanted to. But then also at the top of the website, you can click on visual tour. And this is a really good video for if you want to show what we do to somebody and they don't want to watch a 35-minute webinar. This 12-minute video can be sped up and watched at 1.5 times. So like in 8 minutes, someone can watch this and really get what we do on a high level and understand our strategies and the structure and really get a good feel for who we are. So you can just go to investorresidences.com to look at the portfolio of properties, at this video, or to get in touch with us about any other questions that come up.
Amazing. Thank you. And I may have missed it while I was multitasking. I know you said for people that invest 25,000 or more, they have that benefit outside of their IRA of that one night per $25,000. Do you have any minimums?
Yeah, we try to keep the minimums at the $50,000 level, but we do know with a lot of self-directed IRA groups that they may have 15,000 or 25,000 right now, and they may have more later. I know I've got I think it's called a HSA, like health savings plan, that only has 14K in it. So I know exactly how that goes. So we're not super crazy strict on that. We, outside the self-directed IRA world, we try to keep it at 50 just so we don't have 400 investors in the fund. But we really like working with Camaplan. So we'll be flexible with people coming in from your platform.
That's very much appreciated. And it looks like your presentation went so well that you didn't leave any questions behind for anybody else. So if anybody watching this now or in the future has any questions for Richard or Investor Residences, please feel free, like Richard said, go to this website, watch the content, reach out to him. If you have any questions about your self-directed IRA and how any of this applies to you and your retirement funds, please give us a call. We have no dial directories. We always answer the phone. So please feel free to reach out. And I want to thank you, Richard, one more time for, lending your time to us and providing us with a little bit more education.
Sure. Yeah. Appreciate the chance to be on here. Thanks, Will.
Thank you. Take care.
Take care. Bye.